Okay, so another method for computing depreciation is the units of production method. And so this is a good method to use when you're going to be using the plant asset in different amounts during the period, or from period to period, I should say. So we're going to calculate depreciation expense in two steps. And the first step is done when you first put the plant asset into service. So when you first put the plant asset into service, you're going to calculate the depreciation per unit. Right? And then every period when you're taking depreciation, you're going to take that depreciation per unit and do step 2. So step 1, to calculate depreciation per unit, we're going to take the depreciable cost, the cost minus the residual value, and divide that by the estimated units in the useful life. How many units do you think you're going to get out of that plant asset over the entire time you're using it in your business? That's how we get our depreciation per unit. And so you, as I said, you do that when you first place the asset into service, and you use that depreciation per unit every period when you are going to be recording the depreciation expense. So the second step is when you actually calculate depreciation expense. You're going to take that depreciation per unit and you're going to multiply it by the actual units for the period. So here's an example. The truck costs $90,000, but instead of looking at the useful life in years, we're going to look at it in miles. So we're going to be able to drive this truck for 200,000 miles. Estimated residual value is 15,000. So when the first time we're taking depreciation, we're going to calculate that depreciation per unit by taking the depreciable cost, the 90,000 cost minus the 15,000 residual value. So that gives us 75,000. We divide that by 200,000. That gives us 0.375. So our depreciation per mile is 0.375. So every period when we're calculating depreciation, we're going to take 0.375 times the actual mileage for the period. So in year 1, we drove the truck for 48,000 miles. So to get our depreciation expense, we're going to take 0.375 times the 48,000 miles, and we get 18,000 in depreciation. So we debit depreciation expense, we credit accumulated depreciation. Okay, so that's what we do in year 1. In year 2, we'll take the 0.375 times the number of miles we drove in year 2, which is going to be a different amount. Okay, so unlike straight line, it's going to be a different amount every year if you use the depreciation differently. If you use the asset differently. So what's the book value of the truck going to be at the end of year 1? Well, we've made this journal entry, debit depreciation expense. 18,000 is reported on the income statement under operating expenses. Accumulated depreciation gets credited. So our book value will be the truck's cost of 90,000 minus the accumulated depreciation of 18,000. 72,000 will be our book value. Okay. So here we can see in year 2, we drove 30,000 miles. So our depreciation expense in year 2, we take 0.375 times the 30,000. 11,250 is the depreciation expense in year 2. So we will make the journal entry debit depreciation expense, 11,250, and that's what gets reported on the income statement. We credit accumulated depreciation, 11,250, and when that credit gets posted, now accumulated depreciation has a balance of 29,250. So our book value is the 90,000 cost minus the 29,250. So our book value at the end of year 2 is 60,750. And so on our balance sheet, we'll add 60,750 to the book value of all our other plant assets to get our total plant assets. That gets added to your total current assets when you're getting your total assets on your balance sheet. Our third method of depreciation is the declining balance method, and this is an accelerated method. We're going to take larger depreciation amounts in the beginning of an asset's useful life and then smaller amounts towards the end. So this is considered, right, that's why it's considered an accelerated method. And the rationale for taking more depreciation in the beginning of the useful life is that when the asset's new, it's going to be the most productive. And so we're going to calculate depreciation by multiplying the book value by, and if we're going to be doing double declining balance, so we're going to do double the straight line rate. So the straight line rate, usually you just divide by the useful life, but for double the straight line rate, we're going to take 2 divided by the useful life and multiply that by the book value. Okay, so this one's a little different. We're not looking at depreciable cost in our formula. We're looking at book value, right? And book value is the cost minus the accumulated depreciation. The thing that gets tricky about the double declining balance method is we can't depreciate our asset below its residual value. And in fact, when we get to the end of the useful life, it needs to be, book value needs to equal residual value because that's what we think we're going to get when we're done using the asset. So here's an example. We got that same truck, $90,000 cost, 5-year life, residual value 15. So depreciation expense for year 1, the book value times 2 divided by the useful life. Well, we've never taken depreciation before now, so accumulated depreciation at this point is 0. So in year 1, book value is going to be equal to cost, right? Cost minus accumulated depreciation is book value. Accumulated depreciation is 0, so book value equals cost in year 1. So we're going to take the 90,000 times 2 divided by 5. That gives us 36,000 in depreciation. We'll debit depreciation expense 36,000. We'll credit accumulated depreciation 36,000. And so our book value at the end of year 1, 90,000 minus a 36,000 accumulated depreciation gives us 54,000 is our new book value. So now when we go to year 2, it's book value times 2 divided by the useful life of 5. So it'll be 54,000 is now our book value times 2 divided by 5. 21,600 is now our depreciation expense. Okay, so the book value is going to be changing every year. It's going to be going down. The 2 divided by the useful life, this is going to be the same every year. So we could go to the accumulated depreciation T account and take the 36,000 accumulated depreciation for year 1 and add the 21,600 accumulated depreciation that we recorded in year 2, and we could get the balance in accumulated depreciation, right? So what would that come to? 57,600. Subtract that from the 90,000 cost to get us to the book value. Okay. Another way you can get book value is taking last period's book value and subtracting this period's depreciation expense. So now our book value is down to 32,400. So in year 3, we're going to go 32,400 times 2 divided by 5. Depreciation expense in year 3 is 12,960. We'll debit depreciation expense 12,960, credit accumulated depreciation 12,960. Okay. And so our book value at the end of year 3, if we take last period's book value of 32,400, subtract this period's depreciation expense, now we've got book value of 19,440. So in year 4, we take the 19,440 book value times 2 divided by 5. That gives us 7,776. So when we subtract last period's book value minus this period's depreciation expense, it comes to 11,664. This is a problem because residual value is 15,000. We should have 15,000 as our residual value when we get to the end of the useful life. I'm sorry, 15,000 should be the book value when we get to the end of the useful life. The book value cannot go below the 15,000 residual value. So when we get to the point where using the formula will bring the book value below residual value, or in the very last year, if it hasn't happened sooner, we need to force depreciation expense. We're not going to use the formula in that year. We need to force depreciation because book value needs to equal residual value at the end of the useful life. Okay, so this is happening in the second to last year. If it doesn't happen before the last year, you definitely do it in the last year. You definitely will have to force it in the last year. So the way we force depreciation expense, we take the book value minus the residual value, and that's the depreciation we can take in that year. So the 19,440 book value minus the 15,000, 4,440, right? 7,776 that we got using the formula was too high. We can only take 4,440. When that gets subtracted from last period's book value, we end up with a book value of 15,000, and that is our residual value. That's what we want it to show. Okay. So if it didn't happen in year 4, you would have had to do it in year 5. You have to do it in the last year if you don't do it sooner. At some point, we do have to force depreciation by taking the difference between book value and residual value. So then in year 5, depreciation expense is 0. The truck is fully depreciated at the end of year 4. The book value will still be 15,000, and that's what we want to happen. We want the book value to equal residual value at the end of the useful life. So here is how your plant assets section on your balance sheet will look. This is what you will need to do on your Excel assignment. You show the plant asset at its cost, and then you subtract the accumulated depreciation, and you put the book value in the right-hand column, right? And then we add together the book value of all of your plant assets to get your total plant assets. Okay, so that's what you're going to do on your Excel assignment. Probably in your financial analysis project, you didn't have all of this detail. It was probably in a note to the financial statements. They would have just shown the plant assets net of $97,450. And then they would have had a note where they provided the detail on the accumulated depreciation. Okay. All right, so I'm going to end this video here, and we'll start with the next topic of partial year depreciation.